people come to me for financial advice, I say, which is more important to you, keeping what you have or making more? And they say both. You can't do both with equal emphasis. Every attempt to make more introduces the possibility of not having any more what you have today. So you have to decide the balance between aggressiveness and defensiveness. And then if you're really bold, you can think about varying it over time as the circumstances require.
You can make your dream of financial freedom a reality by using a strategy that is so strong it makes your financial future not only safe, but also well established. This isn't just any strategy. It's the strategy of dividend investing, a method that has silently been fueling the portfolios of the wise and patient investors among us. The power of dividends enables investors to achieve relatively good returns while simultaneously safeguarding their savings. That's why Howard Marks, a legendary investor known for his ability to navigate market cycles and find hidden investment opportunities, holds substantial stakes in dividend stocks. Since 1926, dividends have contributed approximately 32% of total return for the S&P 500. But beyond just numbers, dividends represent a share of the company's profits, directly rewarding you, the shareholder, for your investment and trust. It's like having a golden goose that lays regular golden eggs. Now, what if we could amplify this power, turning it into a monthly income of $4,700? Yes, you heard that right. $4,700 every month just from dividends. It's not a myth. It's a possibility that requires insight, strategy, and a bit of wisdom and guidance from one of the investment world's greats, Howard Marks. Today, we're going to look through Marks's playbook and find 8 dividend stocks that are not only good, but also golden. Stocks that you buy once and hold forever, letting them work for you, generating a steady stream of income month after month. Our discussion will also cover Marks's investment philosophy, the math behind earning $4,700 per month, and the best ways to get there. Before we begin to look at our dividend stock selections, it's important to understand the guiding principles of Howard Marks, a luminary in the world of investing. Marks endorses the concept of defensive investing, a strategy that prioritizes safeguarding against losses over chasing speculative gains. He famously said, "The most important thing is to avoid losing money." This mantra is especially relevant for dividend investors seeking reliable income streams. Marks is renowned for his emphasis on investing with a margin of safety. This principle involves selecting investments priced well below their intrinsic value to cushion against unforeseen market downturns. For those of us looking to live off dividends, this means focusing on companies not just with attractive yields, but also with solid financials and a competitive edge that can weather economic storms. Another important aspect of Marks's philosophy is the importance of recognizing and understanding market cycles.
I believe that there are cycles and that they're extremely important to understand. I believe there always will be cycles. I have followed cycles for 50 years. I think I've been able to help our clients by dealing with the cycles.
He believes that being aware of where we stand in the cycle can significantly influence our investment decisions. For dividend investors, this awareness can guide us in choosing stocks that are likely to maintain or grow their dividends across different market conditions. Selecting dividend stocks that align with Howard Marks' investment philosophy means looking for companies with a blend of stability, growth potential, and resilience. Marks famously said, "You can't predict, you can prepare." Here's a condensed guide for picking such stocks. Point number 1. Track record of dividend payments. Choosing companies with a long history of consistent dividend payments, like Johnson & Johnson, which has increased its dividends for over 5 decades. This history indicates financial health and a commitment to shareholders. Number 2. Proven business models. Focus on companies with durable business models and a competitive advantage, such as utilities providing essential services. Their constant demand ensures reliable dividends. Number 3. Competitive edge. Look for companies with a unique selling point, whether it's innovative technology or a strong brand like Apple Incorporated. This edge helps maintain profitability and dividends. Number 4. Essential services. Companies in sectors like healthcare, which provide indispensable services, offer stability and are less affected by economic downturns, making their dividends more secure. Number 5. Sustainability. Invest in companies committed to sustainable practices. As Marx notes, being forward-thinking in sustainability aligns with long-term value creation. Number 6. Strong corporate governance. Good governance is key. Companies that prioritize shareholder interests tend to support consistent dividends and growth. By focusing on these 6 criteria, investors can identify dividend stocks that promise not just immediate returns, but also long-term growth and stability, embodying Marx's approach to investing wisely and defensively. Now let's look at the 8 dividend stocks that meet our criteria, inspired by Howard Marx's investment philosophy. While specific stock recommendations would require Marx's direct endorsement, we can suggest sectors and characteristics of companies likely to fit his approach. These include established utilities with a history of reliable dividend growth, leading consumer staples companies known for their enduring brands, and healthcare giants innovating for the future while paying steady dividends. Each stock selected stands out for its financial health, market position, and potential to deliver consistent returns over time. Stock number 1, NextEra Energy, or NEE, a leading utility company known for its significant investments in renewable energy. NextEra Energy's commitment to sustainable energy solutions and consistent dividend growth makes it a compelling choice for long-term investors seeking stability and innovation. Number 2, Procter & Gamble, or PG. As a consumer staples giant, Procter & Gamble boasts a wide array of essential products and a long history of dividend payments. Its strong brand and global presence exemplify the type of company that can weather economic cycles while providing steady returns to shareholders. Number 3, Johnson & Johnson, or J&J. A healthcare company that offers a diverse portfolio of products spanning pharmaceuticals, medical devices, and consumer health. Johnson & Johnson's commitment to innovation, coupled with its dividend aristocrat status, reflects the resilience and growth potential Marx often highlights. Number 4, PepsiCo, or Pep. Another consumer staple standout. PepsiCo offers a broad portfolio of food and beverage brands. Its focus on expanding healthier product lines and consistent dividend increases align with a long-term, growth-oriented investment strategy. Number 5, AbbVie, or ABBV. A biopharmaceutical company known for its strong pipeline of drugs and commitment to research and development. AbbVie's robust dividend yield and potential for long-term growth through innovation make it a match for Marx's criteria of investing in companies with a competitive edge. Number 6, 3M, or MMM. With its diversified technology and a solid track record of innovation across various sectors, 3M exemplifies a company with a strong moat. Its consistent dividend growth and resilience across economic conditions align with Marx's emphasis on quality and stability. Number 7, Duke Energy, or DUK. As one of the largest electric power holding companies in the United States, Duke Energy's focus on renewable energy and infrastructure investment positions it well for future growth. Its history of dividend payments supports Marx's preference for companies that can deliver consistent returns over time. Number 8, Verizon Communications, or VZ. In the telecommunications sector, Verizon stands out for its extensive network infrastructure and commitment to expanding its 5G capabilities. The company's steady dividend payments and potential for growth in a digitally connected world resonate with Marx's investment approach. To achieve a monthly income of $4,700 from dividends, especially through the 8 stocks inspired by Howard Marx's investment philosophy, requires strategic planning, substantial investment, and an understanding of the different methods to maximize dividend returns. Let's explore how to reach this goal, the investment needed, the time frame, and compare the methods available. Let's take a closer look at the most straightforward way to make money through dividends, which is by directly investing in individual stocks. For our example, we're focusing on the 8 dividend stocks we talked about earlier. We're going to assume that, on average, these stocks give us a 4% return every year just from dividends. So here's how it works. If you want to earn $4,700 every month from these dividends, first you need to figure out how much money that is in a year. Multiplying $4,700 by the 12 months in a year gives us $56,400. That's the total amount of money you'd want to get from your investments in 1 year. Now, to find out how much money you need to invest to get that $56,400 a year with a 4% dividend yield, you divide the yearly income you want by the yield percentage. In simpler terms, if you divide $56,400 by 4%, it tells you that you need to invest about $1,410,000. So to wrap it up, if you're aiming to make $4,700 every month from dividends, and the stocks you've chosen give you a 4% return on average, you would need to invest approximately $1,410,000. This calculation assumes that the dividend yield stays steady at 4%. Now, let's talk about another way to grow your dividend income, which is through dividend reinvestment plans, often called DRIPs. DRIPs are a fantastic tool because they automatically use the dividends you earn to buy more shares of the stock, without you having to do a thing. This means your investment can grow over time as you accumulate more shares, and those additional shares will earn dividends too, creating a snowball effect. Imagine you start with the same goal of making $4,700 every month from your investments, which adds up to $56,400 a year, just like before. If you're using DRIPs, the key difference is how your investment grows over time thanks to compounding. That's when your earnings start earning their own earnings. Let's say you initially invest in those 8 dividend stocks we discussed, aiming for that 4% average yield. But instead of taking those dividends as cash, you enroll in DRIPs. Over time, as your dividends buy more shares, your total number of shares increases. This means you could potentially reach your income goal with a smaller initial investment compared to just collecting dividends, because your investment base, the total value of your shares, is growing. However, calculating the exact amount needed with DRIPs involves many variables, like the rate of dividend growth and how often you reinvest your dividends. But the principle is, by reinvesting your dividends to buy more shares, you're setting up a cycle where your investment could grow faster than if you were just collecting the dividends as cash. So while it's hard to put a precise number on the initial investment needed without knowing specific growth rates, the idea is that DRIPs could lower the amount you need to start with to reach that goal of $56,400. The trade-off is time. You're relying on the power of compounding, which is most effective over long periods of time. This means it might take several years to see the full benefit of using DRIPs to boost your dividend income to the level you desire. Moving on to the third strategy for maximizing your dividend income, let's explore the concept of covered call strategies. This approach can significantly enhance the yield of your investment, potentially making it easier to achieve your goal of $4,700 per month in dividends. Covered call strategies involve owning dividend-paying stocks and then selling call options on those same stocks to generate additional income. Here's a simplified way to understand how this works and what it might mean for your investment. When you sell a call option, you're giving someone else the right to buy your stock at a predetermined price within a specific time frame. In return for selling this option, you receive a premium, which is essentially extra cash in your pocket, on top of the dividends the stock pays. This premium adds to your overall yield, increasing the total return on your investment. Let's apply this to our goal. If employing covered call strategies can boost your overall yield to, say, 8%, combining dividends and option premiums, the math changes in your favor. To earn $4,700 per month, or $56,400 annually, with an 8% yield, you'd calculate the required investment like this. Instead of needing around $1.41 million at a 4% yield from the direct investment in dividend stocks, you'd now divide your annual income goal of $56,400 by 8%. This results in needing an investment of approximately $705,000 to achieve the same monthly income. This is a significant reduction in required capital, thanks to the higher yield from incorporating covered call strategies. However, it's important to understand the trade-offs and risks involved. While selling call options increases your income, it also caps the potential upside of your stock. If the stock's price skyrockets beyond the strike price of the call option, you might have to sell it at a predetermined price, missing out on some gains. Additionally, this strategy requires a more active management approach, as you'll need to select and sell options regularly. In comparison, direct investment in individual stocks is the most straightforward approach, but requires significant upfront investment, $1.41 million at a 4% yield. Dividend reinvestment plans, or DRIPs, leverage compounding to grow your investment, but still necessitate a sizable initial outlay and time for the compounding effect to manifest significantly. Covered call strategies offer a path to higher yields, potentially reducing the needed investment to about $705,000 for an 8% yield, but come with limitations on potential stock gains and require active portfolio management. Your choice should align with your investment style, risk tolerance, and financial goals, keeping in mind that achieving a substantial monthly income from dividends is a complex process that balances yield, growth, and risk. And there you have it, a roadmap inspired by Howard Marks to potentially earn $4,700 a month through carefully selected dividend stocks. We have studied his investment philosophy, found stocks that meet his criteria, and calculated how to reach your income goal. Now, we turn the conversation over to you. Which of these strategies resonates most with your investment style? Are there dividend stocks you've had your eye on that fit the Marks mold? Share your thoughts and questions in the comments below. Let's continue to learn from each other and grow our portfolios together. Until next time, keep investing smart and living well.